Welcome to our quarterly bulletin. My name is Mithula Sikakana and I'm the Business Development Manager at Equilibrium Investment Management. It is my pleasure to be hosting you this morning. Before we commence, just some housekeeping. We applied for Continuous Professional Development or CPD points. It is very important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of November and receive your CPD points. Our operations team will email your CPD certificates to you during December 2024. Please also feel free to ask any questions in the Q&A section and our speakers will either answer them live or get back to you after the event. You can find more information about our speakers under the Speaker tab located on the top menu bar, or if you scroll down. Additionally, if you'd like to download the presentation being shared today, look for the PDF download link. Okay, let's kick off the session. First, we have Nomathamsanqa, an economic analyst, and Sanisha Packirisamy, our economist, who will be talking about how interest rate cuts are affecting our global economies.
Good day, viewers. I am Nomathamsanqa, economic analyst at Momentum Investments, and with me today is Sanisha Packirisamy, chief economist at Momentum Investments. I think maybe, Sanisha, to start off, we can reflect back on the previous quarter. We saw it was quite eventful with some twists and turns. What were some of the major events that stood out for you?
Thanks, Yamo. Great being here with you today. I think there were two major events that came out. The first was the move by the Federal Reserve in the United States to cut interest rates for the first time in this cycle. It was a long-awaited interest rate cutting cycle that has now finally commenced. And the second big event was the 5th of August. And so quite interestingly, if you were sitting at your desk at the beginning of August and you came back at the end of August, it would have looked like nothing had happened. However, markets took quite a nosedive on the 5th of August, and this was predominantly on the back of the unwinding of the Japanese carry trade. And that was really because the yen had strengthened on the back of the Bank of Japan increase in interest rates, and investors out there were actually betting that monetary policy would remain stable for a little bit longer. However, the Bank of Japan saw an opportunity to raise interest rates because finally, after a very long time, they've managed to get wage inflation going again, and it looks as though they can get to that 2% sustainable level of inflation. Now, outside of these technical factors which drove the market lower, we also had some fundamentals in markets that had started to look like they were going to deteriorate. The first was on the back of geopolitical risks with Middle Eastern tensions that were hotting up. And we also saw a very poor set of data coming out of the US that was centered around the jobs market. And this really stirred a lot of concerns in the investor community. But as I've said, going back and looking at many years before this, we've often had these big market corrections. And given that it was mostly technicals driven, we believe that the fundamental structural picture of the global economy didn't really shift all that much during this time period.
I just want to take us a little back and focus on the US labor market. We saw that the US labor market has been softening. The unemployment rate increased to 4.3% in July, but we did see an improvement back down to 4.1% in September. Centered around the US labor market is the debate around the soft versus hard landing. We're seeing a lot of those concepts being thrown around. Can you maybe just explain that a little bit more to us? And do we have an idea of what a soft landing looks like?
Sure. So, a hard versus a soft landing is a concept that investors use to describe how hard the economy will fall in an interest rate cycle. Now, there's no definitive concept saying that a soft landing is X% growth and a hard landing is X% growth, but it's generally assumed that a hard landing would fall in line with an economic downturn that the National Bureau of Economic Research would then classify and define as an actual recession. We've seen that former Federal Reserve officials actually look at a soft landing in the context of growth not contracting by more than 1%. And so if you take data all the way back to 1965, up until the COVID-19 crisis, you'd see that we probably only had about 4 actual soft landings in the US economy. So it's actually quite difficult for the Federal Reserve to engineer a soft landing. Now, if we look at the probabilities around whether we're going to get a hard or soft landing, these have also shifted quite a bit over the last while. So if we dial back about a year ago, the markets were anticipating almost a 60% probability of a recession occurring in the US economy over a 12-month period. And this is calibrated by the Bloomberg consensus numbers. So this was a time at which, economic data was surprising to the downside. But however, we got into 2024 and US economic data started to surprise quite meaningfully to the upside. And on the back of that, we saw that the recession probability started to decrease. And we saw that the markets were then paring back their expectations for interest rate cuts as the data looked stronger. And we also saw that core inflation measures were looking a little bit stickier. And that, of course, would mean that the Federal Reserve couldn't cut by as much. Then we entered that period of the August market wobble, and markets became a little bit concerned that maybe there's more weakness than what we are seeing in the US economy, and then started to price in a little bit more risk. However, the recession probability on that Bloomberg measure remained at 30%, so basically a 1 in 3 chance. So it's not completely dismissible. There is still that risk that prevails. But if we look at the underlying resilience of the US economy, and we know that the consumer is a very big chunk of growth in the US economy, we continue to see some strength being portrayed there, despite the fact that pandemic savings are running out. Going into an interest rate cutting cycle could also provide a little bit more support for growth as we start to see GDP now soften into the next years. We've come out of a period of very elevated growth rates in the US economy, far above trend. And on the back of that, we do expect some softening in growth measures to come through. So we're very much in the soft landing camp, as the markets probably are as well. If we look at what global equity markets did for the third quarter of the year, up 6.6%. So definitely not suggesting that a hard landing in the economy or full-on recession is impending.
Just touching back on, you mentioned the strength of the US economy and linking that also back to the robust labor, the payroll numbers that we saw in September. Would you then say that the 50 basis point cut that the Fed delivered in September was a mistake and they could have only delivered a 25 basis point cut?
Well, the Fed has been deeply criticized over the last while. Firstly, they were criticized for being behind the curve when they raised interest rates to fight inflation. And of course, we saw that big inflation wave hitting them. And then subsequent, when inflation started to fall and the economy started to show some cracks emerging, markets then assumed that the Fed had waited too long. I think we are now at a point in the cycle where the Fed has to juggle the potential for inflation to lift off a reasonably lower level than where it was before, but at the same time having to manage the underlying resilience of the economy. And just like all the other central banks out there, it is going to be a bit of a wait and see approach. We often hear central bankers saying that they are data dependent, and I think this is exactly what is happening. So you get one stellar payroll sprint and it almost changes the psyche of investors in terms of what they're assuming on interest rate cuts. So again, taking it back about a year ago when that recession probability priced in was 60%, the markets were looking for the Fed to cut between 5 and 6 times by the end of this year. When the data started to emerge in the beginning part of the year, looking a little bit stronger and core inflation was a lot stickier, the markets pared that back to between 1 and 2 cuts by the end of the year. We've now sort of evolved into a place where the markets are looking to about 4 interest rate cuts for the year, signifying that they are still a little bit worried about the underlying resilience of the economy.
So we do see that the globe is on a monetary policy easing cycle, but the Asian markets are evolving quite differently, as Japan has increased interest rates. And this is partly because they didn't implement stimulus packages that shot up inflation as much as in other countries. We also saw stimulus packages in China. Do you think that is enough to bring up the growth? in the country?
Well, I think investors were waiting for this juncture at which, Chinese authorities would finally blink, given that economic data has been quite soft. And quite a bit has been done. They've spanned, numerous portions of the economy trying to target higher levels of economic growth. And it did surprise to the upside in terms of the interest rate cuts that they've put through and the commitment to further fiscal stimulus. However, if we really want to fix the underlying weakness of the Chinese economy, particularly on the depressed consumer sentiment side, we really have to fix the stream of permanent income for consumers. And I think that this quick fix is not the way to do it. We're also seeing, in terms of the measures that they're putting forward for the property sector, it won't necessarily arrest the continued downward spiral in the property sector. So while I think it is a positive that authorities have come out in a meaningful fashion and surprised to the upside in terms of their stimulus measures, and have announced a willingness to do more if necessary, I think that authorities probably do have to do more in the next couple of months in order to find a bottom on the property sector and to really spur consumer sentiment in a more meaningful way in a country that doesn't really have a very good social security or pension reform net.
Outside of markets watching monetary policy and the decisions of central banks, markets are also paying quite close attention to geopolitics, because we do say that geopolitics are hotting up. So the recent move with Israel, do you think that is enough to gather some support from Iran and other allies?
I definitely think in these latest moves from Israel's side that a significant tripwire has in fact been triggered. Israel has shown that they want to protect their borders in quite a meaningful way. And this, of course, has caused a lot of civilian deaths in Lebanon. We think that out of all the scenarios that could happen from here, we're probably likely to see more of a loss of life in Lebanon. I think at this stage, the scenarios kind of pan from the milder to the most severe. And in a milder kind of scenario, we continue to see Israel taking out more of that command structure of Hezbollah. And in that kind of world, it will also weaken Israel because there is a cost attached to that. That would be more of a ground incursion that continues. It could also be a case where they go to an air defense kind of system, and that might mean that they could take out the long-range military defense system from Hezbollah, and that would become more ineffective. I think the most severe outcome that the markets are not necessarily pricing in as a central or base case scenario right now is for Iran to back Hezbollah in a more meaningful way. And I think one of the key reasons that Iran hasn't done so and has mostly just, fiddled around with the chess pieces on the board and not really gotten involved in a meaningful way is that they don't really have the military capacity and funding to do so. And so in a world where Iran does in fact become involved and does back Hezbollah in a more meaningful way, we could potentially see Iran's allies also becoming involved, the likes of Syria. This could then mean that the regional conflict starts to spill over into a more globalized conflict involving greater superpowers like the US and China. Now, in that kind of world, and particularly one in which Israel could potentially destruct some of the oil infrastructure in Iran, would then push up the global price of oil. With higher oil prices comes through a bigger inflationary impulse, and then that would take away some of the interest rate cuts that central banks would be able to do. I think ultimately that kind of a world does mean a more stagflationary outcome where you have raised inflationary pressures, but also with higher rates of market volatility and higher oil prices, you could see a reduction in growth. And that is going to be a very difficult environment for central banks to operate.
In line with the topic of geopolitics, another factor which could potentially change the global economy is the US elections, which are coming up on the 5th of November. So we're seeing from the polls that it's quite a very small margin between Kamala Harris, although she's still leading now, and Donald Trump. So a lot of the outcome will depend on the swing states and what small voters in the swing states do. Do you have an idea of the possible scenarios of the outcome and how that could potentially affect the economy at large?
Sure. So if you look at the possible outcomes, it could range from, a red sweep where we have the Republicans in control of both chambers of Congress and led by Donald Trump, all the way to a blue sweep where we have the Democrats being in charge of both chambers of Congress with a Harris victory. We think that something in between is likely to come out, and we think that a split Congress is the most likely outcome. If we look at, the polls that you're suggesting, in the past, we've seen that polls haven't actually been all that accurate, and a lot depends on the swing voters as you get closer to the election date. And I think this time is no different with that. But I think this time around, our base case scenario, and again, relative to the other scenarios, it's a very small margin at this point in time. But we're looking for a Harris victory with a split Congress outcome. Now, whenever you have a split Congress outcome, it means that a lot of the policies are watered down because you don't have both chambers of Congress agreeing on everything. Now, in that kind of a world, and potentially even in a blue sweep scenario, you would probably have more regulation, higher taxes, and markets don't like that because it's bad for corporate profitability. So that could be a slight market negative that comes through. Ultimately, this would be better for growth because under an environment that is more democratic-led, we would see a more positive environment for foreign policies and foreign affair matters. In an environment, I think, on the other end of that spectrum, which I think bears out the biggest sort of tail risk, is a red sweep scenario with Trump at the helm. Almost a Trump 2.0 kind of scenario. Now, in that kind of world, there would probably be an easing back of regulation. He's already announced that he wanted to cut corporate taxes. That's great for corporate profitability. So we could actually see equity markets bouncing positively on the back of that. Ultimately, however, markets would become very worried about the tariffs that he wants to impose. As he's mentioned, a 10% across the board tariff, which would negatively affect emerging markets in quite a big way. That rise in protectionism and the rollback in regulation could actually be very negative for growth further down the line. The cutting of taxes could be very negative for the fiscal and debt outcomes, and we could potentially see with higher debt to GDP figures down the line that the legitimacy of the US dollar is tested in quite a big way. So while initially that kind of outcome would be quite positive for financial markets, I think further down the line the market will then cotton on to all of those risks attached.
So in general, we do see that there is a big risk of like populist policies, right? Which I guess is also something that us in South Africa experienced leading up to our May elections, where we had a risk of populist policies emerging in the instance that, for example, we had a coalition with the ANC and the EFF or the MK, and that would have led to negative implications such as negative economic growth, negative impact on the currency, and also potentially some backpedaling on private sector participation in the renewable and logistics space. Since then, we did see the formation of the Government of National Unity emerge, and that has been quite well received by the market. But there are still risks attached to that, particularly with the conflict of resolution agreements, which we've seen globally that GNUs that fail are failing because they don't have that type of agreement in place. So if there's still that risk, where are we gaining the confidence for growth going forward?
I think that there are some areas of structural reform where all the parties belonging to the Government of National Unity have broad agreement. And what gives me quite a lot of confidence in thinking that growth on a 3 to 5 year time frame might be better than what we're currently experiencing really emanates from the second term that has been granted to Operation Vulindlela. Operation Vulindlela is a project office that sits between National Treasury and the Presidency, and they've been looking at ways to cut regulatory red tape in areas like energy. You've mentioned the renewable space, in transport, in water, and a number of other industries. Operation Vulindlela's first term, they actually managed to tick off a lot of their objectives, and they believe that over that course of the 5 year term that we've already seen, that they've potentially unlocked about 500 billion rand worth of investment in the economy. So taking that into account and the fruits of those reforms, we could potentially get growth close to 3.5% by the time we get to the end of this decade. However, if we look at the interim growth numbers for this year and next, we are still hamstrung by certain structural bottlenecks in industries like logistics. So yes, while we've seen an alleviation on the energy supply constraints, we are still contending with water outages, we are still contending with port and logistic constraints, which is likely to keep growth at around 1% for this year and about 1.8% for next year. Operation Vulindlela's second term will also focus on things like spatial housing, fixing the problems at local municipalities, and this gives us quite an optimistic view on longer-term trend growth for South Africa.
I think with positive growth, we're also quite optimistic about the trajectory of inflation. We expect inflation to average about 4.7 this year and come down to 4.3% next year. So that is quite a welcome improvement from where we come from over the past 2 years. So with growth doing well and inflation trajectory heading on a downward trend, what do you think the SARB's next moves are from here?
With regards to the Reserve Bank in South Africa, we faced a very similar kind of market pressure that the likes of the European Central Bank, the Bank of England, and more recently the Federal Reserve have faced in terms of having to cut interest rates as inflation has fallen and as growth concerns start to emerge. Now, in the South African context, we need to remember that we are still an emerging market. And so here, inflation expectations are still very backward dated. And so we do run the risk of inflation expectations becoming de-anchored whenever there's an external shock that is imposed on the economy. And so I think, the Reserve Bank is on the right road to say that we will cut interest rates in a gradual manner to get back to neutral policy in South Africa, but being very cognizant of those upside threats to inflation that still persist, particularly things like electricity prices. So we're expecting another 3 interest rate cuts in the cycle. And of course, there's still this ongoing debate in markets of whether or not the inflation target will in fact be lowered to a number close to about 3%. And in that kind of world, it does also provide, extra caution on cutting interest rates too much and too soon.
It was lovely chatting to you, Sanisha. Just before we wrap up today's episode, I want to flag what we will be looking out for in the coming quarters. The first thing will be on the 30th of October. The Finance Minister will table the medium-term budget policy statement. Then we'll also look out for what we just spoke about now, which is the US elections on the 5th of November. Just 2 days after that, the Federal Reserve will announce its interest rate decisions, and that will be interesting to watch, particularly given the September payroll figures. Another matter that we will look out closely for is the sovereign credit rating decisions following the budget in South Africa. Thank you for watching. See you next time.
Thank you, Tiamo and Sanisha. Paul Nixon, our head of behavioural finance, will now discuss how two-pot withdrawals threaten to break bad.
Thank you, Matula. Hello, everyone. The two-pot retirement system went live in September this year, and the expected, rather dramatic outflows are indeed being realized. Weekly outflows of billions of rands are still very much evident. While the principle behind the system is sound, being that there is no point in having retirement savings locked up while someone is unemployed and struggling to make ends meet, there will undoubtedly be a significant portion of these outflows that are not desperately needed. In other words, people who don't necessarily need the money will indeed be taking it. This is already evident if we look at data that shows that around a quarter of withdrawals are being used to settle short-term debt like credit cards, for example, and that the average tax being paid on withdrawals is around 35%. Financial education is necessary, but not always sufficient in helping people make better decisions. Why? Simply because knowledge is not always the problem. Many of us know very well that we are making a dodgy decision, and so to align our internal beliefs that we make smart decisions with dissonant information like financial education is telling us, which is that withdrawing and paying tax isn't smart, we either ignore that information or we change our perception of what being smart is. A lot of what we're going to be talking about today is how psychology is helping us understand our behavior better so we can change it. Let's begin by exploring how this works. Remember the very popular TV series Breaking Bad? What made the show so enthralling was the character development and transformation of the anti-hero Walter White, known as Walt. The show started by introducing us to this middle-aged, all-American chemistry school teacher. Soon in the show, he's diagnosed with terminal lung cancer. While discussing treatment options, it also becomes painfully clear that his family doesn't have the best top-up medical insurance plan, and so they can't afford the treatment he needs to stand the best chance of overcoming this monumental challenge. He visits a good friend soon after the diagnosis for his birthday party, where he actually sees that this friend is the CEO of a multi-million-dollar company called Grey Matter. Walt was actually part of the company many years before that, and he sold his share for a few $1,000s after a fallout with his girlfriend, who is now married to the CEO and Walt's best friend from his college days. We find out that Grey Matter is actually a combo of Elliot's last name, Schwartz or Black, and Walt's surname, which is White. Walt stays behind after the party to reconnect with his old friend Elliot. Elliot offers Walt a job and the opportunity to rekindle old times and working together. Elliot brings up a perk of the job being great medical insurance, and Walt's expression changes to anger very, very quickly as he realizes that this is a gesture of pity. This despite Walt's work being critical to the success of the company. Walt refuses the help regardless, causing conflict with his wife. This is a great example to reinforce the importance of internal narratives, or the stories we tell ourselves that generate our perspective. As the show goes on, we learn that Walt's breakup with his girlfriend Gretchen was actually from deep feelings of insecurity. Gretchen's family was incredibly wealthy, and Walt came from more humble beginnings. This feeling created that insecurity. He also felt threatened by Gretchen's relationship with Elliot, whom of course she eventually marries and co-owns Grey Matter with, the result of a self-fulfilling prophecy. Walt resents how the situation turned out because he feels forced out of the company and unable to compete with Elliot. In reality, though, he sells his share of the company willingly for $5,000 because of his ego and pride. Walt makes this decision to create an internal sense of harmony. He doesn't want to confront the issue of his inferiority complex, and so he decides to explain away the situation by processing this as a betrayal. In fact, it was an escape. The theory of internal harmony was proposed by Leon Festinger in the early 1900s. Festinger called this cognitive dissonance and refers to how we process information to maintain our internal sense of harmony. If we don't, the discomfort will grow until we get a form of cognitive toothache that will drive us to interpret any situation in a way that will minimize this discomfort. When confronted with his personal demons, Walt chooses to interpret the Grey Matter situation as a betrayal and leave the situation with some money and ignore his own insecurity. This allows him to return to a harmonious internal state, but of course, as we know, then the plot thickens. The writers of the show, though, are also giving the audience an internal narrative to allow us to get behind Walt. Fans of the show know Walt decides to use his brilliant scientific mind to continually expand his moral boundaries. As people, we all hold common core beliefs. The first is that we are good and decent. Based on this core belief, to maintain a sense of coherence, our actions need to match this core belief, or, once again, an uncomfortable state of dissonance occurs that will lead to emotions like guilt or shame. To give us permission to get behind an anti-hero, we need a good story that can align with this belief. Through a series of bizarre events, Walt soon finds himself using his chemistry genius to cook a near-perfectly pure crystal methamphetamine called Blue Sky. The proceeds of these crimes are used to fund his medical treatment and to replace his income when his illness eventually gets the better of him one day. In the beginning of the show, it's easy to get behind this. Perhaps many of us could see ourselves doing the same thing given the same opportunity. But things get complex when Walt goes into remission and soon starts making much more money than his family could ever spend. But he's no longer the same person. Circumstances have changed. Walt finds himself being able to exert far more power and control in his life than he ever has before, and he actually likes it. Was his metamorphosis into the famous Heisenberg, who was a renowned German physicist, being one of the famous founders of quantum mechanics, who he really was, or not? Walt needs to constantly deal with cognitive dissonance as part of this transformation, constantly creating narratives and recalibrating his moral compass along the way. He starts off with, "This is okay because it's for my family," and ends off with, "Anything is okay as long as it's for my family." But in the process, he destroys his family relationships. So actually, what was the point? Instead of re-evaluating his situation and realizing how far he has deviated from his own moral compass, he constantly doubles down to avoid the cognitive dissonance and maintain his own internal narrative and coherence. This is precisely how people adapt to almost live with themselves when they are faced with this cognitive dissonance. There are many examples of this. Festinger himself studied the behavioural of cult groups who believed they had inside information into the exact date of the end of the world. They even sold all their worldly possessions in firm belief of this strange prophecy. He would infiltrate these groups posing as a believer and found, most intriguingly, that these prophets would become more active after the D-date had passed, which in effect nullified their prophecy. To maintain their own sense of coherence, they would look for more support after a failed prophecy and consciously ignore or filter out any information or media attention that would follow. We often hear that only 6% of South Africans can afford to retire comfortably. We also hear that less than 15% of South Africans have a valid will. If you're near a behavioural scientist when you say or hear this, you'll probably see them cringe. This is simply because while these statements are designed to scare us into action, the unintended consequence is that it's just as likely to result in the opposite. This is because we hear something completely different. Internally, we breathe a sigh of relief because we're just like everyone else that isn't saving enough for retirement or doesn't have a valid will. We don't mind being part of the herd. Behavioural change is much more likely to occur if we can show that in our community or group of friends, for example, our peers, more and more people are starting to get wills or save more for retirement. Behavioural change is more likely when we feel we're missing out or losing out on something instead of fueling the internal narrative of everyone is struggling with this stuff. The behavioural economics team from Old Mutual showed this in a paper published in the Behavioural Economics Guide in 2021. They were able to get more people to preserve their pension savings by using techniques rooted in behavioural science. We each have an inclination to behave in a certain way. This is because there is a genetic component to our personality. For example, some of us struggle with serotonin uptake. Serotonin is our natural, or neurotransmitter rather, which is our natural mood stabilizer. Serotonin is a chemical that carries messages between nerve cells in the brain and throughout our body. If a geneticist picks up a genetic polymorphism, meaning your serotonin transporter gene looks slightly different, it's an indication that you may struggle with mood regulation. When someone with this genetic makeup conducts a personality test, they're usually diagnosed as being neurotic or anxious. There is a biological basis for this though, and that sits in the mechanism for serotonin uptake, which sits in your genes. It is also clear to see this in the famous Stanford marshmallow experiments. The experiment set in the 1970s gave kids aged 3.5 to 5.5 years old the option of eating a marshmallow immediately or being tempted by the marshmallow sitting directly in front of them for around 15 minutes. If they didn't eat it, they would be given a second. Some kids were visibly distraught at the temptation and gave in fairly quickly, while others seemed to develop techniques to make them more focused on the prize of the second. Some covered it, some stared at the corner of the room, while others tapped their fingers in an attempt to distract themselves or perhaps even pass the time better. Later studies in the same group confirmed that these kids were more future-orientated, revealed by a personality trait called conscientiousness. This translated into earning more and also saving more. Having low levels of conscientiousness makes us more susceptible to immediate gratification, and this is where it all starts coming together with the internal narratives we've been talking about and cognitive dissonance or avoiding a cognitive toothache. Let's say a core belief you hold is that you're a savvy financial decision maker. You know that withdrawing your savings pot will incur tax liability, robbing you of the growth of that portion of your savings for years to come. But you also really want to buy a luxury item and you've never seemed to have enough in your credit card to actually buy that, or rather to buy it for cash. You think about withdrawing the maximum amount possible from your savings pot so you can finally buy that Tag Heuer watch. But this conflicts with your core belief that you're a savvy financial decision maker, which makes you uncomfortable. You need to adjust your internal narrative to make sense or create a sense of coherence. How? You play down the behavior by giving the narrative that you're withdrawing to pay off short-term debt initially. You can easily spot someone with this kind of narrative by simply asking them what they've decided to do about the savings pot. If they say, I'm withdrawing, but I've decided to pay off my credit card, it is a clear indication by using but after withdrawal that they know the decision is likely wrong. But they're in a sense asking for permission to do it. Shortly before the two-pot system, in doing some client presentations, one of the most popular questions I had was, should I pay off my credit card? This is almost the same behavior as the cultists looking for support after the prophecy has failed. When we're about to make a decision we inherently know is wrong, the cognitive dissonance will get us to seek support for our decision while at the same time actively filtering out any other information that will add to our cognitive dissonance. To highlight how powerful and necessary this narrative function is, the University of New South Wales showed more evidence in 2019 of being able to predict people's choices around 10 seconds before they reported being consciously aware of these decisions. This research is done under an fMRI, where activation in the executive decision function of the brain, which is where conscious decisions are made, is clearly visible. This research started in the 1970s and has been conducted in numerous contexts and with many different types of decisions. Think for a second about what this means and what this means for the construct of free will. The next time you walk into a conference center and you approach the table with the healthy and unhealthy snacks, the chocolate muffins and fruit skewers, know that you've already made your decision. The uncomfortable feeling you get when you're shoving the chocolate muffin, which is basically breakfast cake, into your mouth will set off a process creating a narrative you are comfortable with. It's okay, I'll go for a jog later. Just remember, you should never trust your future self. The trend of two-pot withdrawals to settle short-term debt, particularly in higher income earning South Africans, could very well be linked to the personality trait of conscientiousness, specifically low levels thereof, making that person susceptible to immediate gratification or living more in the present or in the now. To alleviate any cognitive dissonance where that person has had the financial education to tell them that this is not the right decision, that person will set about creating an internal narrative to help them live with what they know is a dodgy decision. There are very likely many other effects at play here, like the small amount effect, where the wrong decision is much easier to live with if the maximum withdrawal is proportionately a small amount of the total amount at play. But as we gather more personality data, we'll be able to understand these effects much, much better. This is really where personality science holds so much promise, as we're able to use AI to predict people's personality, and we're able to examine what financial decisions they make. The two personality traits that translate very well across a number of decision contexts are conscientiousness as well as neuroticism or anxiety. Simply put, those of us who are conscientious should be better savers, more cautious drivers, and take a full course of antibiotics, which are different decision contexts. The Momentum Money fingerprint is able to measure a number of dimensions that reveal the extent of a client's present versus future orientation. You can see on your screens the results of a Momentum Money fingerprint for a couple. Don't worry too much about the labels, but focus rather on the shaded areas and note how different they are in size and shape. Without going into too much detail, let's start with the one on the left. The white area here, or number 4, is much bigger and reflects someone's experience in financial markets and their associated confidence, financial market knowledge, and how they usually behave when markets fluctuate. Moving on to the red area, or number 1, we can see it's much smaller compared to the right. The white area in this case is translating into more risk aversion or lower risk tolerance. In fact, the only small red peak on the left is indicating that the person is feeling a lot of risk at the time of the assessment. Moving on to the green area, or number 2, and the yellow, which is number 3, we can also see that the area that they cover is much less. One of the reasons is the degree of present orientation or preference for now over later and lower levels of risk composure. The only green peak is coming from a high level of extroversion, also characterized by spontaneity, being highly social and with an external locus of control. Interestingly here, this means that a bad experience would likely be brushed off as, oh well, that's the way financial markets work. You win some, you lose some. Someone who is introverted, like the person on the right, is far more reflective with an internal locus of control, or regularly seeking their part in both successes and failures. This is where things get quite interesting, as extroverts usually pair quite well with introverts. In this case, these two contrasting pictures are from a couple. The husband on the right is very future-oriented, prefers structure, planning, and discipline with strong future orientation. He also has a green peak for money anxiety, and so worries about money quite a bit. The smaller white area indicates better risk behavior, though, that is usually associated with greater financial market knowledge and confidence. This also translates to a greater risk tolerance in the red area. The larger yellow and green areas once again refer to a future orientation and a preference for planning over spontaneity. While these two pair well from a social perspective, balancing each other out, I can tell you they experience a high level of money conflict. The wife on the left in this case is the breadwinner, and so the family spending closely follows her preference for spontaneity and the fact that she doesn't worry much about money. Naturally, this stresses the husband out tremendously. These are types of diagnostics that can help resolve money conflicts. Perhaps by establishing some control over spending in exchange for the husband being more present in family fund situations instead of being absent and being anxious. This also shows how our factory settings or personality play out in respect of our money behavior and how this information can be so valuable for financial advisors in preventing two-pot withdrawals. Who of these two, for example, would you think is more likely to withdraw their savings pot? A story perhaps for another day. With new knowledge and insights into people's personality, money attitudes, and risk behavior, the financial advisor is able to use techniques in financial psychology to help those that are more spontaneous and present-orientated to become more goal-orientated. It is very important to remember that there are no bad personality traits. There are, however, good and bad personality traits for a given situation. The spontaneity that generally defines extroverts leads to more rich life experiences and most certainly interesting stories to share. Neuroticism, for example, or elevated anxiety sounds negative because it means that person worries more. But this usually also includes worrying about others, which manifests in a more caring person in many cases. Financial education is necessary but often insufficient in getting actual behavioural change. A study by the American Psychology Association, highlighted in a book called Money Mammoth by Brad and Ted Klontz, confirms that using money psychology is 3 times as effective as financial education in getting people to save. The test group exposed to techniques in financial psychology that help people visualize their financial goals, for example, are much more effective than telling people how wonderful compound interest is. Many studies have shown how we struggle to quantify the effects of compound interest. While some of us are better than others at focusing on the future, that doesn't mean we all don't need a little help sometimes. And sometimes this can be as simple as a visual reminder of what we're aiming at. I also think that AI has a strong role to play in behavioral change. I just returned from a behavioral finance conference in Los Angeles where I presented Momentum Investment's work in using AI to help people stay invested. What was quite incredible was the Chinese use of smart cities to help people develop a much bigger green consciousness and ultimately invest a greater portion of their portfolios in green funds. When you order takeout in a smart city, choosing no cutlery earns you green points and your actual carbon footprint is freely available and visible to you on your smartphone. Walking to work gives you green points and is tracked via your mobile phone. They can even calculate how much time you spend at toll booths and if you're driving your own car, which has a heavy carbon footprint, or if you're in a green cab. Machine learning is used to monitor and learn from your behavior to establish what baseline norms are and how much these are being impacted, and more importantly, what more successful interventions will be. Points are also awarded for recycling batteries and appliances, as well as carbon footprint saved. Most of us are completely oblivious to these factors. Some of this may start to make you feel a little uncomfortable. Sounds a bit like Big Brother. But there can be no doubt in this case that the technology and tracking is being used for good. I hope you enjoyed the chat we've had today, and please do look out in 2025 for news on the financial psychology program that we're working on for financial advisors. We also have a competition running where 20,000 Rand in Take-A-Lot vouchers is up for grabs if you'd like to help us collect some data from your existing wealth clients using the Momentum Money fingerprint. Please do email me for details. Thank you very much.
Thank you, Paul. Next, we've got Nomathamsanqa Khoza, a portfolio manager at Equilibrium, who will be discussing how local markets and how she sees the phoenix rising from the ashes. Pleasure to have you join us today, Tami.
Thank you, Matula, and a very good day to our valued clients and stakeholders. We've titled today's presentation, Local Markets, Phoenix Rising from the Ashes. Looking back, we will discuss markets and portfolio performance. Looking forward, we will share our tactical asset allocation views, as well as portfolio changes. And of course, we will end off with an overview of our local markets. We begin with a high-level overview of how the markets have performed. The third quarter of 2024 ended with healthy returns across most major asset classes, both locally and globally, despite several bouts, of course, of market volatility. Locally, the post-election rally continued with a relatively higher degree of momentum. From a global perspective, market activity remained heightened due to weaker US economic data, an interest rate hike from the Bank of Japan, the US Federal Reserve going into a rate-cutting cycle, and new stimulus in China. Transitioning our discussion to our local model portfolios and how they've performed, of course, in response to what has transpired in the markets. Over its one-year time horizon, our income portfolio outperformed its benchmark, but underperformed the peer group, owing to the residual effects of the side pocketing and write-down of the MyPlan IP-enhanced income fund assets. All multi-asset portfolios delivered reasonable returns over their respective time horizons, with the conservative, stable, and moderate portfolios outperforming their respective benchmarks, while the relatively more aggressive portfolios, which are the balanced, the growth, and unconstrained growth portfolios, remained under pressure. Pleasingly, in the relatively more aggressive portfolios, the degree of underperformance has improved, most notably following last year's rally in global equity, coupled with the recent rally in local asset classes. Of course, this was mainly due to the outcomes of the South African elections. Performance relative to peers was encouraging, with all our portfolios having a higher realized probability of outperforming relative to their respective peer groups over their respective time horizons. Looking at our performance attribution, strategic asset allocation was the highest contributor to performance, while tactical asset allocation and manager selection either contributed slightly or detracted from performance. Pleasingly, over the last 12 months, our multi-asset portfolios remained ahead of their respective benchmarks. We will now discuss each aspect of our 12-month attribution in further detail. The graph on your screens illustrates the weighted realized return from each asset class over the last 12 months to 30 September 2024. The asset classes that contributed significantly to performance were the relative weightings in local bonds, local equity, as well as global equity. Tactical asset allocation speaks to how we underweight, overweight, and take neutral positions on asset classes depending on our short to medium term views. Notably, our underweight position to SA cash was the largest contributor to performance, as we were underweight an asset class that didn't perform as well as the other asset classes. However, the underweight position to global equity was the largest detractor from performance, as we were underweight an asset class that performed relatively well. You will recall that we have since reduced the underweight position in global equity to a neutral position. Manager selection was a detractor from performance across the multi-asset portfolios. The significant contributors to performance were, for a consecutive quarter, our local equity managers Fairtree and Foord, due to their macro investment approaches, as well as Momentum SA Flex, following a very strong rally from local bonds. On the other hand, the detractors were Visio Unconstrained. This manager has a conservative duration position, A-led equity, mainly from a stock selection impact perspective, as well as Coronation Global Emerging Markets, due to their benchmark agnostic positioning. So let's take a look in terms of what this means for our tactical asset allocation for this quarter relative to last quarter. The portfolios have benefited quite pleasingly from our slight overweight position in local equity. You will note that with global equity, we have not increased further from a neutral position. And the recent market activity has proven why, in the build-up to the US elections, with many unknowns, coupled with monetary and fiscal policy regimes by major economies, a neutral position is the best allocation and the right decision at this time. We can all concur that the rebound in our local markets has been a rather pleasant and most welcome surprise, following protracted periods of underperformance, most notably in growth asset classes. And so in the same vein, we would like to leave you with a famous quote by Octavia E. Butler. In order to rise from its ashes, a phoenix must first burn. To all our valued clients and stakeholders, we continue to thank you for your support and partnerships. We hope you have found this session to be very informative, and we thank you very much for your time.
Thank you, Tammy. Lastly, but most certainly not least, we move to our colleague in London. Please welcome Jade Coysh, a portfolio manager from our London office, who will provide us with a global update and let us know whether the tides are changing globally. Welcome, Jade.
Thank you, Matula. Thanks everyone for joining us today. As you can see from this slide, we have entitled our quarterly update, Are the Tides Changing? The narrative looked quite different during the third quarter compared with previous quarters where it's all been about mega cap tech. With inflation coming down, we've seen market leadership change more recently, and what we want to do is dig a bit deeper into that. So as you can see from this slide, US jobs data has softened, but it certainly doesn't look weak. If we overlay inflation onto this chart, you would see that the Fed has actually done a pretty good job in reducing inflation whilst avoiding crashing the economy. And if we expand this out a little bit, for the most part, central banks globally have in fact done a pretty good job in reducing inflation whilst avoiding recession and managing monetary policy pretty well. This chart here shows that across the curve, we've seen US yields falling during the third quarter. And again, this is a similar picture for other key regions. Broadly, this is the picture that we would expect to see as inflation starts to come down and interest rates have started to come through during that third quarter, particularly that larger rate cut in the US of 50 basis points, which was somewhat unexpected, but certainly welcomed. And the expectation is that we're going to continue to see these interest rate cuts coming through going forwards. Now, what does this mean for markets? What did this mean for markets during the third quarter? Well, broadly, everything that has been out of favour and underperformed over previous quarters has done particularly well during the third quarter of this year. And the key driver of this is, of course, those interest rate cuts feeding through to asset class performance and also to valuations in multiple areas of the market. This is particularly the case for property, which you can see by that bar on the right-hand side of this chart. There's been no change to underlying fundamentals of the asset class, but performance has been very positive. And this is also true of bonds, where yields have fallen and it's benefited the asset class. This performance profile has in fact benefited the positioning of the portfolios in general during the quarter, where we have quite diversified portfolios. We're not just invested in equities and bonds, but we are invested across various asset classes, including property, and diversified within underlying asset classes like fixed income as well. So delving a little bit deeper into equities performance, you can see here from this chart that previously favoured areas like sort of growth equities or large cap equities have actually underperformed during the third quarter. And then there are other areas of the market that have done much better. For example, value biased equities, quality equities, and that's denoted by the red and green bars on this chart. And this has really benefited a lot of the equity funds within the portfolios, which are diversified across styles and also tend to be underweight mega caps as well. So this has been a positive narrative for our equity, global equity fund during the third quarter. Now, it wouldn't feel right to do a quarterly update without mentioning the Magnificent Seven, but the picture looks very different compared to previous quarters, with the Magnificent Seven actually lagging the rest of the S&P 500 constituents. You can see here that the equally weighted S&P 500 index has outperformed the general S&P 500 index, and this just indicates that positive performance has been driven by other areas of the market. It's been a lot more broad brush. It hasn't just been about that very small number of stocks. And this has been very positive again for active managers who have struggled to overweight the mega cap tech names in the index because they make up such a big part of the S&P 500. And also we feed into that, and it's been positive for the global equity fund. Now, this next slide offers a little bit more detail, showing that that leadership of the technology sector. It might be over, it might not, but this shows that over the quarter, technology performance was pretty muted, whereas year to date, it really has sort of dominated. Again, performance has been much more broad brush across sectors. It hasn't just been about technology. And again, it's been positive for our global equity fund. It's impossible to say if this performance profile will continue for the foreseeable future, but it is possible that this is the start of valuations starting to revert to their long-term average, and this is a philosophy that MGIM do really believe in. So I just wanted to finish the macro update by talking about Chinese equities, which experienced a very healthy rebound in the final days of the third quarter. The Chinese government made an announcement of a stimulus package, and this caused a significant rebound in Chinese equities performance, which you can see from the green and red lines on this chart. Share prices within the Chinese market are highly tuned into what the central authorities are doing, and the timing of this announcement may have been a bit intentional, but the market reaction was certainly noticeable. Now, we think that this trade still has further to go. We think that there is still more opportunity for Chinese equities to recover slightly further, and this is reflected in our allocation to emerging markets within the underlying portfolios. Now, this is just our regular reminder of the resource that you have over here in the UK. So you can see that this is all the photos of the team. So that you have myself and Richard Stutley circled there as the two people looking after the Equilibrium portfolios. I won't dwell on this slide as we do give this update pretty much every quarter, except to say that this will be my last quarterly update for a little while, as I am going on maternity leave. So you'll see more of Richard in the upcoming quarterly updates, and he of course is supported by the rest of the team. Now, just a quick recap on the 3 Equilibrium portfolios. So again, this is something that we touch on every quarter, but we have the Coysh portfolio, which has a higher allocation to bonds and it has the shortest holding period of 3 years, and that is our least risky portfolio. And then in the middle there, you've got the managed portfolio, which is a more balanced allocation between equities and bonds, and a small allocation to alternative assets as well. That has a 5-year holding period recommended, and a sort of medium risk profile. And then on the other end of the spectrum, you have the Equilibrium Growth portfolio, which has the highest allocation to equities, and then a small allocation to alternative assets as well. And the holding period is the longest of 7 years, because the expectation is that it's the riskiest portfolio and it would have a bit more volatility. This chart here, again, is one of our mainstays. So this shows longer term performance of the 3 portfolios. You can see here that Coysh, Manage and Growth all continue to outperform their cash plus targets. Q3 performance has been very strong, and that has meant the deviation between the cash plus target and performance of the portfolios has widened, but in a positive way. So obviously happy with that outcome. And then this slide here, I just want to focus in more back onto the third quarter. All 3 portfolios generated positive performance well ahead of their cash plus targets, and also ahead of the respective peer groups as well. Performance for the recommended holding periods, which I always like to touch on at these quarterly updates. It's denoted in the black squares there for the 3 portfolios. So for Managed and Growth, both of those are ahead of their cash plus targets. However, for Coysh, the portfolio is slightly lagging the cash plus target, and that's because of the previous performance of fixed income. However, third quarter performance has meant that the portfolio has sort of closed that gap a little bit. And when we zoom out to longer term performance, all 3 portfolios have outperformed their cash plus targets. Now, looking a bit into performance attribution of the 3 portfolios, so manager selection within equities benefited Coysh, Managed and Growth. The exposure to gold and also the allocation to property benefited the portfolios in which they are held. On the negative side, for Coysh, the marginal underweight to fixed income, particularly that allocation, that slight underweight allocation to government bonds, was actually a drag on performance, because that was the strongest performing asset class within fixed income. But for all of the portfolios, the allocation to cash was a detractor, and that's because we saw positive returns across all asset classes, so it would have been more beneficial to be fully invested. But overall, the positives outweighed the negatives by a healthy margin across all 3 Equilibrium portfolios. So we're very happy with the result that we've had this quarter. Looking into underlying manager performance, all of the underlying funds generated positive performance on an absolute basis during Q3. Standout performers were, unsurprisingly, given the narrative that we've just gone through, the 91 Global Gold Fund. This fund continues to benefit from the increase in the commodity price, which continues to increase because of rising geopolitical uncertainty. And then we have the Catalyst Real Estate Fund generating very strong performance during the quarter. So this again is those interest rates cuts coming through, benefiting underlying valuations. It's not to do with fundamentals or any sort of catalyst in the portfolios, but it's just a beneficiary of those interest rate cuts. And then lastly, we have Coronation and Sands Emerging Markets. These equity funds were among some of the top performers in the fund lineup, unsurprising as you have that allocation to Chinese equities, which saw that significant rebound. So unsurprising that these are the standout performers. These are the themes that I've discussed throughout the presentation. So we're seeing the performance of those coming through quite nicely. Now we've included this slide which delves a little bit deeper into the Global Equity Fund, which on the previous slide obviously shows as a single line. But this shows that there are multiple underlying funds within that portfolio. And just to touch on maybe something that I think is important to highlight, you can see that a notable contributor within this portfolio has been those small cap funds. So Granahan and Paradise, they are smaller weights within the portfolio because they do have a slightly higher risk profile. But overall, those two funds make up 7.5% of the portfolio, of the Global Equity Fund. And those funds those two small cap funds have done exceptionally well and really contributed to performance overall. Then on the other side of the spectrum, we have Jennison, which is a large cap growth fund. That's been the worst performer. It's been the best performer for many quarters. It has a higher allocation to those Magnificent Seven stocks and generally a higher allocation to the technology sector. And it is a growth fund, which is a style that has underperformed relative to other areas of the market. So nothing too surprising in there, but good to just get a bit of a look through on how our underlying managers are performing. Now, in terms of our asset allocation views, there hasn't really been any significant change to our high-level positioning and views of the asset classes. Our portfolios remain slightly underweight equities, and that's largely because we think US equities are overvalued compared to other areas of the market, and it does make up a significant portion of the global equity index. And then we are positive on the more alternative asset classes within the portfolios, and this is demonstrated by our allocations to gold and property, which have done very well. So the broad positioning of the portfolios have been beneficial as we've see those the shift towards positive performance from other areas of the market. So in terms of our outlook, we believe that the inflation problem and the relevance of the inflation problem is really fading. Central banks, as mentioned, have done a great job of navigating the course of bringing inflation down without leading their economies into recession, and they've managed monetary policy pretty well so far. We're not out of the woods yet. We expect that this is a new regime of generally higher interest rates compared to the previous decade, but the environment certainly is normalizing now. So we think we're coming to the end of this period where inflation and interest rates have just dominated the full narrative. In terms of economic outlook, it's quite a mixed bag. The US continues to outperform and generate quite strong growth, but other large economies continue to struggle to achieve decent growth. So Germany, the UK, China, for example, they're all struggling a lot more than the US. And then when we turn to risks, of course, the stark risk is geopolitical escalation. This is a risk that's pretty much always there in some terms. But at the moment, it certainly is elevated, and there's a lot of uncertainty around that. Valuations, on the other hand, aren't really that bad. Across various asset classes, we're seeing pockets of value, particularly in the bond market. We think there's a lot of opportunity there. And overall at MGIM, we believe in valuations. So we're somewhat cautious today, but our long-term view is that we think there are attractive opportunities there, and attractive valuations outweigh the risks. Thanks so much for listening in today.
Thank you, Jade. That wraps up our quarterly bulletin for the day. We know how valuable your time is and would like to thank you for supporting Equilibrium and for joining us today. We hope you found this webinar insightful. Until next quarter, goodbye.